Hello, and thank you for joining us for today's webinar. My name is Ben Powers, and I'm a partner in Pitcher Partners Business Advisory and Assurance area. I have a specialisation in audit, and I am well versed working with clients each reporting year in relation to their impairment assessments. We have all been living with COVID-19 and its immediate impacts for a number of months now. However, this webinar today will be forward-looking to the June 2020 financial reporting season, and we'll aim to provide you with guidance and insights as to what you need to be considering in detail for year-end in relation to your impairment assessments. As this heading for our webinar suggests, we're expecting it to be a challenging year for clients in undertaking their assessments given the uncertain environment we are all in. We hope you gain some clarity and confidence to tackle the challenge in relation to your impairment assessments from today's session. I will be joined today by my colleagues Rebecca Spencer and Liesl Malcolm from our corporate finance team. Rebecca is a manager in the team and Liesl is a client director. Both have extensive experience in business valuations, typically analysing and preparing discount cash flow calculations. They both also work with our audit teams and clients during the reporting season to provide their expert insights and guidance in preparing impairment assessments. They will both take you through the main part of today's webinar, providing you with detailed guidance on things you need to be considering in preparing your impairment assessments for this upcoming reporting season, with a particular focus on the impact COVID-19 will have on your impairment assessments. I will introduce the session by touching on the current issues and uncertainties we are facing with COVID-19 and why it is important for you to consider these in preparing your impairment assessments. I will also touch on guidance from the regulator ASIC in the current environment, discuss why financial report disclosures in key areas will be very important for this year. Provide an overview of the relevant accounting standard ASB 136 when considering your impairment assessments. And as a registered company auditor, I'll try and provide some tips along the way in preparing your impairment assessments for director and auditor scrutiny. We're all aware that COVID-19 has had a massive impact on the world economies and has and will continue to create a very uncertain economic outlook for many businesses. The challenge is going to be for this reporting season in making impairment assessments will be adequately dealing with the many uncertainties that are out there. To name a few, there's obviously been whether there's a longer term impact of COVID-19 on your business. So how quickly will your business recover from that would need to be factored into your DCF analysis for your impairment assessments. There's obviously been a number of support measures put out by state and federal governments, such as JobKeeper. A lot of those are due to finish up. The JobKeeper is due to finish up the end of September. So again, what does that mean for your business and your future forecasts? The implementation of potentially new government measures have recently been talked about. So again, what impact will they have? Obviously, there's been massive restrictions on overseas trade, given borders have been closed. So again, if you've got a business that's exposed to overseas trading, then you'd need to factor those into your forecasts and your impairment assessments. And what impact has it been in just general in accessing to your markets and your supply chain? Certainly things that we'd need to consider. And we're also seeing across our client base massive disruption to business models, as maybe people are calling a new COVID world in terms of new models, business models that are being developed in response to that. So again, if you've had to be innovative to get through this, what does that mean, and what does your business look like going forward? So there's a lot of things to consider, and what we're seeing and what we're expecting to see in this reporting season, that there'll be many entities that may never have previously considered the risk of impairment to be anything other than remote, may as a result of the changes because of COVID-19 may need to work through the impairment process in a lot more detail. So just because there was headroom or even significant headroom in prior periods does not mean that this may not be an issue for you and your business in the current period with the increased uncertainty. So from a regulatory perspective, I thought I'd share this slide. ASIC have recently released their frequently asked questions, I suppose, in relation to COVID-19 and implications for the financial reporting and audit season. So this is in addition to their normal sort of guidance around their normal focus areas for financial reporting. But in response to the issues being caused by the pandemic, they've expressed their view that their focus is going to be on recognition and measurement in particular, and a key focus on the valuation of assets, which is obviously relevant to our session today, including intangibles, property, inventories, receivables and loans, investments, other financial assets, contract assets, and deferred tax assets. They'll be also focused on the correct recognition of liabilities, including provisions for onerous contracts, financial guarantees, and restructuring. And they'll also have a focus around adequate disclosure for key sources of estimation uncertainty, so which again was relevant for impairment and asset valuation assessments, and key assumptions and sensitivity analysis disclosures, which again would be relevant for your impairment assessments. In relation to the director's report, they're keen for the director's report in the operating and financial review to include adequate disclosure around the underlying driver of results, business strategies, risk and future prospects. In relation to the going concern basis of accounting, they're expecting adequate disclosure as per normal in relation to going concern assessments and solvency, which, given the current environment, may be more relevant. They're also expecting adequate disclosure around subsequent events, which again would be relevant in the current environment because we're seeing things changing so quickly, and we're likely to see it to continue to change quickly post 30 June. So subsequent events disclosures, I think, will also be critical. So the other thing we've got this year too is obviously the new Leases standard for many entities that are applying that for the first time. So again, ASIC's just put a reminder that you should be considering disclosure requirements in relation to that new standard. But also it's relevant in terms of the right of use assets that get created with that new standard. They also would need to be considered as part of your impairment assessments for this year. As discussed on the previous slide, obviously there's a focus by ASIC in relation to disclosure in the financial statements. So there's likely to be an increased expectation around this in the current reporting period to include greater disclosure, sources of estimation, uncertainty, key assumptions, and sensitivities, which may be more variable than the prior periods given COVID-19. So you really need to consider whether your disclosures will be sufficient to support the basis of preparation of the financial report applicable to your entity. They need to be clear to the users of the accounts. They should be concise and effective and not lost in unnecessary detail, and they shouldn't really be boilerplate in nature, which I know as an auditor we do see quite a lot, and try to make the disclosures as specific as we possibly can to your entity. So the disclosures should need to also have a reasonable basis. So from an auditor's perspective, you need to consider that you've got enough support and evidence to be able to provide the auditor to support the reasonable basis of the disclosures you're making, and overall supporting the audit opinion the auditor's got to make. So, as previously mentioned, preparers of financial reports really need to consider whether the variety of uncertainties and changes from COVID-19 will impact the level of disclosure they need to make to support the basis of preparation and the fair presentation of the financial report this year. So, getting back to your impairment assessments, it's likely this year that additional support and preparation will be required for your impairment assessments, including detailed cash flow models to determine whether the assets you're assessing are impacted. Can't stress enough that starting early is the key. It's likely to ensure that you don't have any unforeseen outcomes which could derail your reporting process down the track. You really need to look at documenting your key assumptions and consider the evidence you have to support the reasonableness of the assumptions that you've made in your forecasts and your DCFs. Evidence, obviously, as I've touched on, will be key for auditors to see. And given the uncertainties we've talked about, performing sensitivities on key variables and assumptions in your cash flow models, as well as scenario analysis, will be important and will better demonstrate that you've gone through a due process in your impairment assessments. You need to also ensure that the directors are engaged early in the process and they are adequately across the impairment assessments. It's extremely important they have had a chance to challenge the key assumptions and confirm their reasonableness. It's obviously a good governance process. I know as an auditor we tend to see that either the auditors are brought in very late in the piece, but also the directors as well, and it can cause issues if there's disagreements in relation to your key assumptions that have been made in your impairment assessments. So again, I can stress again, engage your auditors early, engage the board early, and also as part of the process, consider whether you need any expert help from a valuation expert in determining any of your key assumptions. Obviously today you'll get some insights from Lisa and Rebecca in terms of things you need to consider, but I really encourage you to seek help if you need it when you're dealing with your impairment assessments. Now I'd like to touch on the relevant accounting standards you need to have regard to for your impairment assessments, which is AASB 136. I won't be going through the standard in detail, but really just providing a brief overview of the key principles. So in relation to scope, it applies to all assets other than those in the scope of other specific standards. So in scope are property, plant and equipment, right of use assets under the new lease standard, investment property at cost, equity accounted investments, investments in subsidiaries at cost, intangible assets, and of course goodwill. Out of scope and dealt with by other standards are financial assets, inventory, contract assets, deferred tax assets, and non-current assets classified as held for sale. As you're probably already aware, there is an obligation for testing goodwill and intangible assets with indefinite useful lives at least annually. So that's always a requirement each year. All other assets that are in the scope of the standard though only have to be tested for impairment when there's an indicator of impairment. But as was previously mentioned, we're probably likely to see, given the impact of COVID-19, there's going to be a lot more businesses that are likely to have an indicator of impairment. So it's likely to bring those other assets in scope in your impairment assessments this year. So in your impairment assessments, remember the concept of recoverable amount is important. For an individual asset and a cash generating unit, recoverable amount is the higher of its fair value less cost of disposal, which is typically the selling price of an asset by market participants, and its value in use, being the present value of future cash flows from an asset or CGU. The level at which recoverable amount is determined, so you determine this for the individual asset at that level if possible, obviously except goodwill, which is always tested at the CGU level. If it's not possible to assess recoverable amount of an asset at its individual level, you can determine its recoverable amount based on the CGU in which the asset belongs. So if you do determine that there is an impairment loss in your impairment calculations, for an individual asset, remember that you don't reduce the asset below its recoverable amount, but in a CGU calculation, you obviously reduce the impairment loss against the goodwill first, and then apply the rest of the impairment loss to the assets allocated to the CGU on a pro rata basis, but again, not below its recoverable amount. In terms of specific COVID-19 impacts, considering the following points will be useful. So obviously indicators of impairment. So given the current environment we're in, it's likely that many businesses will have indicators of impairment and will bring into scope the assets other than goodwill that will have to be assessed for impairment. It's important that obviously your forecasts and budgets are based on reasonable and supportable assumptions, and that'll be key for your auditors in their assessments as well. Discount rates and other economic assumptions that will go into your DCFs, they must be reflective of current market assessments. And Rebecca and Lisa will provide some further insights later in the presentation in relation to appropriate discount rates and other assumptions you should be factoring into your impairment DCF calculations for this year. Risk and uncertainty will likely be greater this year, as we've discussed, but remember to reflect the uncertainty and risk in your future forecast or the discount rate, but not in both. So we do see that from time to time when we're assessing impairment assessments, that the discount rate is factored in a risk premium, but the cash flows have also been pared back. So remember to not double dip on that. And similarly, don't forget also to consider the positive factors that may contribute to offset some of the risks and uncertainties. In relation to experience to date, recent history is probably likely to be the most useful pieces of information to rely on in preparing your forecasts. But also do remember that for many businesses, it may not be appropriate to use historical information. As I've mentioned previously, there may be a new normal for your business. So basing your forecasts on prior history may not be appropriate. In terms of your impairment assessments, it's important that they're based on conditions that existed at reporting date. But where matters are clarified post year end, this will be a key point of consideration in determining the market conditions at reporting date, as opposed to it being new information post period end. It's highly likely that for most businesses that COVID-19 has impacted their business at 30 June and therefore the impact must be determined and factored into impairment assessments. The information that is incorporated is certainly something you'd probably want to discuss with the auditor throughout the audit process, particularly for those entities reporting later in the reporting season, where there's likely to be more clarity on the impacts of COVID-19 on the business. There's certainly a lot to consider this year in relation to impairment assessments. I would now like to hand over to our presentation to our two valuation experts, Liesl Malcolm and Rebecca Spencer, who will provide an expert view on what you need to consider in your impairment assessments for this reporting season.
Thank you, Ben. As mentioned, my name is Rebecca Spencer. I work in the Corporate Finance Division, specialising in valuations. Thank you, Ben. Really appreciate you joining us for our webinar today. It's always really good to have our auditors involved. Us in the corporate finance team work really closely with the audit team during this season, and I think we're going to be doing a little bit more this year. So, are you ready for a major test of impairment? It's a very exciting topic. I think all of us, including you, are going to learn so much from this particular topic because we're going to come across probably a few different challenges, and we always take away and learn the most from the biggest challenges we have.
Now, myself, Liesl, and our Greater Valuations team complete a number of different valuations engagements for our clients. These are generally driven by the green headings here: financial reporting, litigation, acquisitions, tax and corps law, and generally are for business and share valuations, employee equity instruments, intangible assets and purchase price allocations. So on top of all the beautiful valuation work that we do, we also support the firm with their corporate finance needs, and in particular for the audit team, their impairment reviews. This year, when conducting impairment reviews, we are going to be looking to go back to basics, just like some of our business valuation engagements, to make sure that we really understand the business and how they compare to the market when we're having a look at their impairment reviews, because it's going to be more and more important this year to be able to understand exactly how that business fits into the market in comparison to their peers and by taking into account their cash flows, etc.
So what we consider the key focused areas for impairment testing this audit season is understanding the business, the cash flows, the historical results, and of course the discount rate. Remembering that the discount rate reflects the risk of the cash flows, and as such we cannot look at a discount rate in isolation because it's fundamentally linked to the cash flows. So please keep in mind that these items are all pieces of the puzzle and they all contribute to drive the outcome of the business value that also ultimately needs to make sense. So this is how we approach our engagements, and in the current economic environment we need to be more vigilant in considering this in respect to our impairment reviews. I'll be covering off on the first three topics, with Liesl taking us through the discount rate in further detail. Understanding the business is something that's really important this impairment testing season, so ideally we'd love to meet with management to discuss any of the relevant risks and drivers of the business, whether or not there's some specific growth that's been projected within these forecasts, and if so, how that growth is going to be achieved. No one knows the business like you do, assuming you are some of the key management personnel or supporters of key management. So we want to know what you think and how you understand the cash flows. This, as I mentioned, is how we undertake our business valuation engagements, and in this year it's going to be particularly important to be able to understand exactly how each business fits into the market and how they compare to their peers. Obviously we want to have a chat about COVID. It's impacted pretty much everything, whether that be negative or positive, long or short term, and we really want to understand what it means for you and your business. Is there a new normal? Is there a permanent effect on the business? How that's been built into the cash flows is something we want to understand, and what assumptions are behind that. Then of course the key business drivers and strengths, weaknesses, opportunities, threats that the business is likely to be exposed to. Cash flows. Now the cash flows are going to be a key important part of our engagement this year. We really want to make sure you understand that these cash flows are intended to represent the underlying business operations. So just think, we want to strip out any noise that doesn't relate to the underlying operations. Passive income from rental properties or investments generally are excluded. Obviously depends on the type of business, but just remember those things as you're preparing them. They don't need to be too complicated, and obviously they should always link back to our financial reporting, but our financial reporting doesn't really reflect cash usually, so just make sure that it makes sense. So ideally we would be looking to receive a discounted cash flow model that management's prepared, usually for their own assessment, and we want to understand a few things broadly around that as well, in terms of, has COVID caused a reforecast? Are we forecasting that we're going to catch up to some of our expected results? And a few of these questions on this slide here are things that we would be thinking about when we're assessing the cash flows. So we want to make sure that you've also thought about these things, and ideally documenting as much as you can when you're providing them to your auditors or as us as an external advisor. So these are key things that we want you to have a think about and document. First off, any key assumption that is driving the cash flows in terms of revenue growth. How is that revenue growth going to be achieved? Is there going to be specific volumes achieved? Is there a new customer contract that's been won? We want to understand the assumptions that are inbuilt into the cash flow forecast. So anything that you've got is really important there. Generally, if there is not much in the way of support for some of these assumptions, we would actually always be asking you, what is that support? Obviously, COVID is a big factor to think about in the cash flows, how that's been factored in terms of, has there been a delay in some of the sales? Has there been closures? What's planned to be reopened and when? Obviously, when we're having a look at this in August, September or July, there might be better information then too. So it's something that's going to be a bit of a moving target for us all this year. So just be mindful that you may need to be thinking about things and updating these cash flows and the supporting assumptions behind them fairly regularly as new things come into play. Obviously in Australia we're quite lucky that things are reopening. Obviously another risk is whether or not your business has got exposure to international markets and how that's been affected as well, and is there a different effect again in those particular markets. As part of COVID, there may be a new normal. We want to understand what that is and why. Quite a few businesses will be changed in the immediate future and potentially over the next few years. So obviously none of us can predict the future, but it's about documenting what we can and preparing the cash flows that we can and what we think is going to be the most realistic scenario. However, on that note, we may also consider, well, what is the worst case scenario? In some of these situations, potentially the best thing for you to also consider is, what's the worst case scenario? What's the most that we can cut our costs to sort of survive? So that's another way of sort of challenging and providing some sensitivity analysis around some of your cash flows. We also want to be careful in thinking about whether there are some other issues within the forecasts that potentially COVID's sort of covering up. Do you find that if you've got any particular products that aren't too successful that may be discontinued, or just some things that might not be split out and as a separate assumption. So these sorts of things will all help support your cash flows. Similar things, we want to know what the industry and results your business has in terms of comparing to its peers, if you are aware. Same with competitors. Who are our customers? We might ask, who your customers are, because these are going to be some of the people who will also have been affected by COVID. This is going to have a flow-on effect to us. Just want to understand what's going on. Obviously, there's a fair amount of costs that are being cut in a number of businesses at the moment while there's been a bit of a lockdown. Now, obviously, things are changing pretty quickly, but we want to understand what has been cut, what redundancies have there been. If you're forecasting a significant decline in CapEx, why? Is that sustainable? Is there a portion of that CapEx that is fixed and you cannot decrease? Is there going to be any catch-up on that CapEx? If we reduce our capital expenditure significantly, we might not be able to grow. So there's all these sorts of factors that interrelate and factor into our cash flows, and we really want to understand how that all works. Now, the key thing and key takeaway from this slide here is that our cash flows are extremely important this year. It's going to be the key focus for us. Cash is king, and the more information you have behind your assumptions, the more compelling the forecasts are. The most important thing to take from today is that you want your forecasts to be compelling, and the way that you do that is by preparing assumptions and information that support those forecasts. So that is a key takeaway from today. In addition to just what we touched on about how important the cash flows are, a further support for us as an advisor would be having a look at the historical financial information. Obviously, if you're a client of ours already, we'll have access to that information, but it is really important to show what has already been the normal for the business and how it compares to our current forecasts. Same thing again with comparing our previous forecasts and our results compared to what we've actually been able to forecast, and see how our current forecast and current cash flows fit in and how they relate. Are they more risky? Are they more conservative? It's really trying to understand the nature of those cash flows. And again, I touched on what the worst case scenario might look like. That could be a scenario analysis that you've done, some sensitivities around the cash flows and what could happen, because yes, the current environment is quite unknown, and we just want to show, and we want to understand whether you've considered that too and how you've considered that. Again, it comes back to the more assumptions and information you have, the more compelling your forecasts are. Same thing with any scenario analysis, and that you've got that information, that you've demonstrated that you have thought about these forecasts and thought about what is a realistic result for the business. And we have AASB 16, the lovely new Leases standard. I'm sure we're all been really excited about this being introduced into the financial reporting this year. And if you've included this change in accounting policy, you just need to remember then that when we are referring to our business cash flows, this new standard creates a lot of noise that we don't want in our cash flows. So we want to strip it all out, and all we want to include in our set of forecast cash flows is the actual cash outflow for the rental expense. So that's something that's probably going to be quite key in adjusting in our cash flows. Another important thing to remember, that when we're preparing our DCF and where you as management are conducting your impairment review, how you do that obviously is by producing your discounted cash flows, which provides a value and use of the business. And then, we compare it over to our net operating assets of the business to identify if there's any impairment. And what's really key here is that we're comparing apples with apples. So if we've adjusted our cash flows and included only the cash component of the lease expense in the DCF, we need to make sure that we've excluded the associated right of use asset and additional balance sheet items that are associated with this new leases standard, so that our cash flows and our net operating assets are comparable. Because otherwise, if one of them has the other, it's not comparing the right asset base to the right set of cash flows. So just remember, we want to strip out all that noise and get back to basics. We just want to see the cash flows of the underlying business assets. I hope that's clear enough about the leases, as we just want to keep it simple. We don't want to overcomplicate it. We have plenty to do in documenting our assumptions and preparing our forecasts. So just remember, just remove that beautiful leases standard that we love so much. Now also, don't forget to reach out to your advisors when you're looking at your impairment review at year end. It's best to engage them early. It's likely to be a much more time-consuming task this year, although, as already discussed, it's going to be very interesting too. The economic environment has thrown a lot of businesses, and it's made the immediate future quite uncertain, but it will be, regardless, a great learning experience working through this period. Now, that's enough on cash flows. I hope you've taken away a few key things that are going to help you this year when you get to your year-end reporting. I'm going to hand over to Liesl now, who's going to take us through the discount rate and just a nice little summary and reminder about what that means.
Thanks for that, Beck. So once you've got your forecast cash flows and you're happy with those, then the next step is to use a discount rate and discount those cash flows to their present value. So AASB 136 requires you to use a discount rate that is a pre-tax rate that reflects the current market assessment of the time value of money and the risks to the asset for which the cash flows have not been adjusted. So in essence, what the discount rate is the rate of return that an arm's length investor would require if they were to choose an investment to generate the same level of cash flows, the timing and the risk profile of that of the asset or the CGU. So the way that we calculate the discount rate is primarily using two different ways. We either have a look at the implied rate for an actual market transaction of a similar asset or business, and we would like, or ideally, to have a look at transactions, sort of recent transactions, so in the last 2 years at most. Or what we do is we have a look at the weighted average cost of capital of a group of listed comparables that do a very similar thing or have a similar risk profile to that of the business or the CGU. So what the WACC reflects is current lending rates, country and currency risk, the cost of capital, risks inherent in this asset or CGU that haven't been factored into the cash flows, any additional risk premiums that might apply, and an optimal level of gearing. So just to point out, the WACC is not perfect, and there are a number of technical valuations issues with it, but it's the best measure that we have. Okay, so here's the fancy formula for calculating the WACC, but essentially what it is, it's the cost of equity and the cost of debt, and weighted proportionately based on an optimal gearing structure. So the cost of equity is what's calculated with reference to the listed companies that we identify as being comparable, and we have a look at their beta, which is a measure of movement and risk to the market. And then we also have a look at, obviously, tax and the current debt structure and borrowing level and rates. In terms of the WACC, you'll note that it's actually a post-tax rate, and while AASB 136 requires to do a pre-tax rate, in practice, you would never, from a valuation perspective, use a pre-tax WACC, or a cost of equity, you would always do a post-tax rate and apply that to post-tax cash flows. So we tend to do the same process for impairment testing. We'll use a post-tax discount rate and a post-tax cash flows, and then we'll work back to determine what the implied pre-tax rate is for financial reporting purposes. And that's something that's accepted across all accounting firms, not just here at Pitchers. So the discount rate considers the risks associated with the cash flows. So let's assume last year we used a discount rate of 11%. There might be a view that the rate of 11% to use this year is high because of the drop in interest rates over the last 12 months, and in particular, the drop in the risk-free rate. So just because the risk-free rate drops doesn't necessarily mean that you should have a lower discount rate. The discounts that we use for valuations are nominal and they reflect inflation expectations. So in your cash flows, what would ordinarily happen is you'll have an RBA, an inflation rate of somewhere between 2 or 3% assumed in each of the years that you've projected, and more often than not, in the perpetuity or the terminal value year is when you'll adopt a CPI type rate of 2.5% is probably what we've seen in the last few years. So if you're going to assume that a long-term growth rate is that 2 to 2.5%, then you need to make sure that in the discount rate, the risk-free rate, then you need to adjust to be a similar level of inflation. So you can't use a 0.2% risk-free rate and therefore reduce your discount rate, but then in your cash flows adopt a 2.5% long-term growth rate. You've got a mismatch there and an inconsistency between what the discount rate is saying and what your cash flows are saying. So you just need to make sure that they're consistent with each other. So let's assume another scenario where we've got a parent company and they use an 8% discount rate for impairment testing. So we've got our CGU, we're obviously smaller, but we have stronger EBITDA margins. So we think 11% is okay. Well, the first things that we need to have a think about is, well, how much bigger is the parent? Are they comparable in terms of what our CGU does? Have we got a diversified company so we do completely different things? Have we looked at the financials? Is the 8% discount rate that the parent uses pre or post-tax? Did they use the same growth rate in the forecasts? And what's the growth profile of the forecasts? We can't just simply say, okay, well, they're bigger, they used 8%, 11% seems okay, let's just do that. You need to do some more background research and analysis of whether the 8% and the 11% is appropriate in both circumstances. So the impact of the recent volatility in capital markets, obviously as a result of COVID, is that we would ordinarily see that betas for a lot of listed entities would increase because there's an increased risk due to uncertainty in the market. So therefore, we probably would expect to see, in most cases, a cost of equity increase. And there may also be further adjustments required to specific COVID factors if they haven't been already incorporated in the cash flows. But we just need to be careful that we're not double counting the impact in both the discount rate and then in the cash flow forecasts. But as a broad statement, we would probably expect discount rates to be higher this time around compared to last year. So if we have a look at this sales forecast graph, what we can see here is one scenario where we've got forecasts in respective sales starting in FY19 and going then all the way out to FY29. Or we assume that we've got a delayed position where those revenues are not actually achieved until FY20 and then obviously ramp up until FY29. So under those two scenarios, all else being equal, and assuming we're comfortable that those forecast assumptions are correct and justified, you would ordinarily expect a higher discount rate in the orange scenario because of the delays in the projections, and obviously it's more difficult to have certainty around the delay, happening in FY20, or, the risk is always that it may be longer than that, versus the green line where we've actually forecasting sales as at today, and where obviously would assume you've got things in the pipeline and revenue already starting to roll in. So the key considerations for the discount rate are: does it reflect market conditions? Is it consistent with the assumptions adopted in the cash flows? And does it double count any risks adjusted for in the cash flows? So that's a really key thing there. Make sure that our discount rate makes sense with the cash flows. Doesn't matter what any other company uses in terms of listed or comparable. Just because another company uses 11% doesn't mean it's appropriate for us to use 11%. Just need to make sure it makes sense in terms of the forecasts that have been prepared. So the key considerations for impairment calculations this audit season are: cash flow forecasts are key. They're going to be the most important thing in determining impairment this year. Ensure your assumptions are fully supported, that you can justify the assumptions that you've made, that they make sense to you, that they make sense to the broader management team. Undertake some sensitivity analysis of those cash flow forecasts to see what the impact is. How sensitive is the business or the CGU to movements either way? Do you think your forecasts are conservative? Are they aggressive? Ensure that the discount rate takes into consideration the market conditions as well as the specific risk factors of the CGU. So again, like we've just talked about, make sure that the discount rate and the cash flow forecast match. Ensure that terminal value or perpetuity value assumptions make sense, especially the long-term growth rate. So if you're using a long-term growth rate that is higher than a CPI level of, that 2, 2.5, 3%, then essentially what you're saying is that your business or CGU will outperform the market year on year into perpetuity. So you just need to make sure that assumption makes sense and that you can justify that position. And lastly, assess your net operating assets, having regard to normal levels of working capital. So just make sure that the working capital position at year end is reflective of a normal level throughout the year. And if not, just need to make adjustments for that. So here are our contact details. So Ben, who you heard from before, Rebecca, myself, and Jason, who is another director in our valuations team. If you've got any questions, queries today or in weeks to come, please reach out, contact us, email us. We're more than happy to chat through any queries or questions that you might have.
Thank you for tuning into this session. We hope you found it helpful and informative. For more information and resources to keep you in the know, follow Pitcher Partners on LinkedIn or visit our website, pitcher.com.au. Have a great day.